Option trading screens can be a little overwhelming at first, but they are a lot simpler than they first appear, especially when you have some practical examples to use as a reference. This video will walk you through how to trade an option on Deribit, how to track the performance of the trade while it is open, and how to close an option position. Once you've got over the first hurdle of placing your first option trade, the option chain becomes much easier to understand. I won't be covering the basic details of what calls and puts are in this video, but if you need to refresh your knowledge on that subject, it is covered extensively in the free Deribit option course. The link to that course is in the video description below if you want to bookmark it for later. I've stripped down the option chain here to look as simple as possible by disabling most of the columns. The different expiration dates are available at the top of the option chain, and we are looking at the 15th of September expiry for ETH here. Underneath in the chain itself, all we have are the strike prices in the middle column, the prices for the call options on the left, and prices for the put options on the right. As with other trading instruments, the bids are other traders' orders to buy the option, so this is what we could currently sell each option for immediately. The asks are other traders' orders to sell the option, so this is what we could currently buy each option for immediately. The bid and ask columns only show the best bid and the best ask, but we can see the rest of the order book by double-clicking on the option we are interested in. This also brings up the order form for that option where we can place orders. We click the row for the 1,550 strike, so the strike price is $1,550, and we clicked on the left side of the chain, so we are looking at the call option. In the top right we can see the order book. The best bid is currently 0.0145 and the best ask is currently 0.0155. But we can see the other bids and asks at other prices as well. Deribit will soon be adding linear options that are priced in USDC, but the options we are looking at today are inverse options, which means they are priced in the cryptocurrencies themselves. So these prices mean 0.0145 or 0.0155 ETH. For now, let's buy one of these 1,550 strike call options. We could buy into the ask of 0.0155 ETH to get an immediate fill. But as there is a bit of a gap between the best bid and ask, we might as well see if we can get filled in the middle at 0.015. To achieve this, we've entered a quantity of 1 and a limit price of 0.015. Then we click Buy, confirm the details, and then send the order. After we send the order, we can see it sitting in the order book as a bid at 0.015. This doesn't last long though, as someone sells into our bid and we are filled at our desired price. We are now long the 1,550 call, which we can see in the positions table below the option chain. We can see the price we entered the position at in the average price column, the current mark price, and the resulting P&L. The actual profit or loss we realise will of course depend on what price we eventually manage to close the position for. We can also see the Greeks to the right of the position table. For example, our delta is currently 0.48. We've traded a call now, and shortly we will trade a put. Before we do that though, I initially kept the option chain as simple as possible just to show how it doesn't have to look scary with hundreds of numbers staring back at us. But now let's add back in most of the useful columns I include on my own trading screen. I like to have the implied volatilities for the bids and asks, the size of the bids and asks, the mark price, and the delta of the options. I also like to have the position column showing so I can see on the chain itself where all my positions are. Notice how even though we've added several more columns and there are a lot more numbers on screen, the bids and asks that we started with are the only ones that show the text in green and red. This allows us to easily find them even when we have many other columns showing. I will cover how I use the data on the option chain to help make trading decisions in later videos, but play around yourself with having different stats on your screen and see which ones you use often, and just as importantly, which ones you don't. So far we have bought the 1,550 call option. Let's now buy the 1,550 put as well. To do that, we click on the right-hand side of the option chain. We could buy this put option immediately by buying straight into the current best ask, but the prices are moving around a little here, So let's try and get filled somewhere in the middle again, like we did for the call option earlier. Let's buy one of these 1,550 strike put options and let's try to pick it up for 0.017 ETH. To achieve this, we've entered a quantity of 1 and a limit price of 0.017. We then click Buy, confirm the details and send the order. After we send the order, we can see it sitting in the order book as a bid at 0.017. Again, someone sells into our bid quite quickly and we are filled at our desired price. The fills won't always be this quick, so sometimes we may need to just take the price that's on offer. We are now long both the 1,550 call and the 1,550 put, and we can see both in the positions table below the option chain. If we ever need to look back and see any of our transaction details for any of these trades, we can navigate to the transaction log from the top right menu. Back to our position. Option traders may recognize the combination of the two options we've bought as a long straddle. We have bought the call and the put with the same strike price and expiration, and with the underlying price currently quite close to our strike price of $1,550, we are approximately delta neutral. We're going to leave this position to run for a bit so the underlying price has a chance to move somewhere that will give us some profit or loss to discuss. We are rejoining the position here about 13 hours later, and the underlying price has increased by about $30 to around $1,580. Our 1,550 call option is therefore $30 in the money, and our 1,550 put option is $30 out of the money. We can check our positions at any time while they are open by navigating to the positions table. In this layout, I have the positions table towards the bottom of the screen. As we can see in the table, the price increase has caused our long call to perform rather well. However, our long put has done poorly, as we would expect with a moderate increase in the underlying price. Although the underlying price has moved away from our strike price, which is what we want when we are long a straddle, it hasn't moved far enough to make up for the theta decay, or the reduction in implied volatility from a little over 40 to under 37. This has resulted in us having a small combined unrealized loss of about 0.0016 ETH. If we think that the price is likely to keep increasing quickly, we can give the position more time, and even hold this position until it expires if we want to. The expiration process on Deribit is automatic, so if we do hold the options until they expire, any value the options have will be transferred into our account immediately. If we don't want to hold the position until expiry though, we can close it early by selling the options back into the market. For the purposes of this example, let's say that we no longer think that the underlying price is likely to move much before the expiry date of our options on the 15th of September. We therefore want to close our long straddle position. To do this, we just need to sell both of our options back into the market. First, let's close our long put option by selling it to another trader. Even though we are closing a position here, we're not in a particular rush, so let's try and get filled between the bid and ask at a price of 0.006. We'll leave that order there while we go and place an order to close our call option. We are long the call option, so to close it we need to sell the call to another trader. Again, as we're not in a rush, let's at least try to get a fill at a price of 0.024. We now have two open orders, one to close the call and one to close the put. Let's see if either of our orders get filled. It doesn't take long for our order to sell the call to get filled at our chosen price. We now only have a long put option position, so we have a decision to make. Do we want to leave our order to close the put where it is, or be more aggressive with it so our entire position is closed? In this instance, after about 10 minutes of waiting, instead of leaving our order there and risking the price moving in the wrong direction, we decide to close the put by selling into the best bid of 0.0055. As we can see in the position table, our position is now 0, so the long straddle trade is over. We have closed both legs separately here to show how this can be done. However, when we are combining multiple options together into well-known positions like a straddle, we can also trade both legs together as a combo if we prefer. This allows us to trade multi-leg strategies with a single order. I will cover combos extensively in future videos. For this first example, we initially bought options and then closed them by selling them. However, we can do this the other way around if we prefer, by selling an option first, then closing it by buying it back, or letting it expire. It's worth mentioning now that being naked short options with no hedge is considerably more risky than being long options. To demonstrate short options in this introductory video, we will use the safest of the short option positions, the covered call. And when I say safest here, I just mean safest from liquidation, because our short call will be covered by a position in the underlying. This time we are starting with about 1 ETH in our account, so we will short one call option against it to create a covered call. A covered call is a combination of a long position in the underlying and a short call against it. We are holding ETH already as our account balance, which acts as our natural long, so all we need to do here is sell an ETH call option. If instead we were starting with a balance of USDC, we would first buy some ETH and then sell the ETH call option. Let's go back to the option chain then and select a call option to sell. We can choose any of the available expiry dates, but for this example, let's go with the 29th of September, which expires in about 10.5 days. ETH is currently trading at around $1,640, and let's say that we don't expect it to go over $2,000 by the 29th of September. We will therefore sell the $2,000 call. We will give up any further upside if the price is over $2,000 when the option expires, but if the price is below $2,000 when the option expires, we will keep whatever premium we collect. As we're choosing an expiry date that is quite close, and a strike price that is quite far from the current underlying price, we won't be collecting much premium. However, this also means it is very likely we will get to keep this premium. Let's try and get a fill at 0.0016 ETH here. Our order to sell this call is now sitting in the order book, so we will have to wait to see if there are any takers. After a few minutes, there are no takers, so let's just sell into the best bid of 0.0015. If we were more patient, or stubborn, we could hold out for our chosen price. However, sometimes we will just want a quick fill, and we may need to be more aggressive to get it. We are now short one of the $2,000 calls that expires in 10 days, and this short call is covered by our spot holdings of 1 ETH. Hence why this type of position is called a covered call. At expiry, we will either have made a small amount of ETH, or the value of our ETH holdings measured in dollars will have increased. I will do a separate video specifically on covered calls in future, but there is also a link to the Deribit option course lesson on covered calls in the video description. We have rejoined the account here about 1 week after selling the call. There are less than 4 days remaining until the option expires, so let's have a look at how the position is performing. The price of ETH has decreased slightly since we sold the call, and a week has passed. We can see in the positions table that this has resulted in the call already losing the vast majority of its value. As the seller of the call, this represents a profit for us. About 87% of the call's value has decayed away, leaving the remaining 13% or so left to decay over the remaining life of the option. For this example, we are going to let the option expire. However, if we preferred, as we've already gained most of what we can from this option, we could roll the short call out in time to collect more premium. To do this, we would simply buy back the call we have already sold, which we can currently do for less than we sold it for, and then we would sell another call further out in time, collecting more premium in the process. We are free to choose whichever of the available expiry dates and strike prices we prefer. So if we only wanted to add a little extra time, we could use one of the October expiries. However, if we wanted to collect a larger premium now and add much more time to the trade, we could even go to the furthest expiration, which is currently June next year. Typically, covered call sellers will choose something with a little less time to expiry so that the call will lose its value quicker, enabling the next round of calls to be sold. There is no single correct option to sell though, and this decision is up to the individual trader. We are holding this one to expiry though, so we are now back in the account just after expiration. There is no longer any position in the position table because the call option has expired. The price of ETH has increased a little since we last checked on the progress, but is still well below the strike price of $2,000, and was when the option expired, so we have kept the full premium that we collected. In the transaction log, we can see the original transaction to sell the call for 0.0015 ETH. We can also see the delivery entry on top, which confirms that there was nothing to pay out. This delivery process is completely automatic on Deribit, so the call simply expired with no further input required from us. This is also true even if the option has some value that needs to be transferred from the option seller to the option buyer. It's all handled automatically the moment the option expires. Our initial covered call is over now, but we are still holding a little over 1 ETH in our account, so we are free to enter another covered call by selling another call option. To do so, we can just navigate to the option chain again and select our preferred strike and expiry date. And we can repeat this process as many times as we like. In this video, we have opened long option positions, the long straddle, short option positions, the covered call, and closed both, either manually or by letting them expire. We have also checked the profit or loss performance of the trades in the positions table while the trades were still open. In future videos, we will go into more details about why we might select certain options to trade, and how we can combine multiple options to give the payoff profile we desire. If you'd like to be notified when those videos are posted, hit subscribe below. And if you don't already have a Deribit account, there is a link in the video description which will get you 10% off your trading fees. Thanks for watching and see you next time.